Bringing across all the developments in the bond market now with Jim Stening from FIIG Securities with me in the studio. Jim, nice to talk. Some assessment, if you could, on where the RBA sees things heading. We've actually had some news out today from one of the members, Gillian Broadbent. She's very bullish on China, calling it really more than a one-off. So when they look offshore, they're quite comforted.
Yeah, look, I think there are a number of factors, obviously, and global markets play a significant role in their deliberations. I think, interestingly, reading through the minutes that were released recently, they obviously are conscious of the fact that the initiation of a tightening cycle is an important step, or a leap, if you like. And I guess the fundamental issue here is inflation. We will have an inflation figure, or the latest data, at the end of October. So sort of in my view, that sort of limits the possibility of a tightening next month. But also, if that data is benign, it certainly does buy them some time as well to initiate the tightening cycle. And I think, as I've said before, I think that one of the things that is a bit of a disaster or potential disaster is to start that cycle and then for that to be proven wrong. I think there's plenty of scope to move rates up by more than a quarter if you need to, if you are lagging the cycle. So yeah, these are the things that they're deliberating.
So really you would say inflation still remains very much on their radar, whereas the sentiment coming out of Gillian's remarks was that perhaps China is core to any interest rate decision making from here on in. Where's the balance?
Well, I guess you need to see the impact of that on our domestic economy, and the data starting to be consistently bullish, and evidence of the recovery that the recovery is entrenched. And I guess that the absence of inflation does buy some time, in my view.
What do you make of investor appetite for government debt at the moment? As we see equity markets, commodity markets rallying, yields are going to have to push higher to entice.
Look, I think you're right. I think one of the sort of the strange developments through this last sort of phase of enthusiasm in the equity markets is that we've also experienced a fairly significant drop in yield. So there's demand for very low risk assets as well. It'll be interesting to see how that plays out, whether that's a temporary thing or not. But look, yeah, there's been some interesting news about looking at major banks buying government bonds and broadening that investor base. When the government was an issuer of bonds, some decades ago, or about a decade ago, the banks were a natural home for those types of assets.
What sort of indication and lead do you get from the US's position? Because unlike us, they have no room to move on rates anymore. It's really been net destructive for the US dollar because no one wants to really hold it, other than to use it as a play then on high-yielding currencies. So does our dollar weigh heavily in its progress in the minds of the RBA, what it might do beyond this point? Because exporters are going to be suffering the stronger it gets.
Yeah, look, I guess so. I mean, I think this is another factor that's weighed into the decision. I think that what we've seen lately is a bit of a capitulation from markets in that they were expecting tightenings. Obviously, that's not the case anymore. But generally, it's an inflation decision in my view.
And one which, because we've seen consumer prices out overnight strengthening in the US, that feeds very much into the inflation mix.
Yeah, look, it does. I think in the US and globally, I mean, I think as far as the stimulus goes and as far as all these, the settings of monetary policy and everything, inflation really is the key. If that's seen to be moving higher in the short term, then things need to change more quickly than previously anticipated. And I think that's the real debate, and I think that those types of figures are going to become very highly scrutinised in the coming months. Any hint of inflation is a very scary thing.
Back to investor appetite now for certain offerings, because we're talking in the last couple of weeks now increasingly about the IPO window being a mechanism that is increasingly being exploited. You think of carsales.com, the darling of the market shortly, which will be Maya today, maybe Kathmandu as well. Now, in that environment, how do you get traction on a retail bond offering and use that as a play?
Yeah, look, it's interesting. I mean, I think, obviously we've seen the CBA Pearls issue of hybrid Tier 1 structure, incredibly oversubscribed, a lot of demand. So, I think that there's still people looking to lock in interest rate assets. I think also, we will see other people come to that market in that space for regulatory capital.
And again, believing inflation will reap the returns longer down the line. I mean, the stronger inflation runs, they'll be the net beneficiaries.
As the debt holders?
Yeah.
Well, debt holders traditionally are exposed to inflation, but I think more importantly, a recovery in the economy. I mean, these assets are offering good yields. I think it's very important. It's a significant development in the market. I think in the repair of the market, because what it does is it gives particularly regulated entities more flexibility in terms of their raising regulatory capital. So rather than going to the share market, or rather than going to issuing ordinary shares, they can look at other structures.
There's another player as well. You've flagged Heritage Building Society. That's an impressive return, 10% on the retail note.
It is, and I guess this is the thing from from the fixed income asset class. You've got very low cash rates, and you've got obviously a performing equity market, but you're also starting to see assets yielding double digits from secure issuers. So as an investor, that's a fairly significant thing to overlook, particularly when you overlay the risk.
What would be the risk associated with that, from coming from a building society as opposed to a bank entity on itself?
Building societies or mutuals are interesting in that they don't issue ordinary shares. So the way that they manage their capital is through retained earnings and also the issuance of these types of structures. But interestingly, Heritage is the largest building society in Australia. A lot of the smaller building societies or mutuals don't have access to capital markets as they do. And
their day-to-day operations, just to clarify for people, what makes them distinctive?
Well, I guess traditionally these mutuals have existed for the benefit of the members, so rather than shareholders. So it's all about service, or what they call in that sector the mutuality dividend. So yeah, it's really basically home lending, very secure lending, low LVRs, small loan.
Banking as well?
Banking, that's right. Yeah, traditional banking.
So much like Halifax in the UK.
Well, yeah, I think there are a lot of building societies or mutuals in the UK. So yeah, it's a very similar model to that.
What is going to be, though, as more entrants come into this space and offer a retail issuance? I mean, are we going to get crowded out? Are we going to get... perversely,
I think you hit the nail on the head. 10% is an attractive yield, so that has implications for other asset classes. It also has implications for for investors, and I think we're probably going to see a lot more of these institutions or a lot of these people considering coming to the market in the retail space, because those types of issues in the wholesale space can't be placed. So there's not that appetite there.
Okay. So it's an alternative, as you say, as euphoria gains ground in equity markets. Don't overlook what might well be and in terms of a timeline for that, Jim, briefly, finally, what are you looking at as far as the maturity on that?
Well, that's a five-year maturity, yeah.
Right, with a 10% payment. Thank you so much.
Thanks, Carl.
See you next week.
Okay.
Right. Jim Stening from FIIG Securities there.